when you put the Trump trade into perspective, you have a lot of risk reassessment from the market. So as you said, there was price for perfection, but what you saw over the past week and a half was equities coming off, as there's a huge divergence between soft data and hard data, as we just saw, for example, auto sales, but also Trump's ability to pass through key elements of reform. And I think the market's now starting to reassess that risk. And what we've been looking at in terms of US bonds is that we aren't as bullish in terms of market expectations for rate hikes this year. So many analysts are forecasting between 3 and 4 rate hikes. We're looking at only 2 for the whole year. Okay. So a little bit below consensus there. And we think over the short term, weakness in equity markets could see US bonds outperform a little bit compared to equities. But we also expect US bonds to outperform relative to European bonds and, let's say, Japanese bonds.
All right, so what are we talking about here? We're at 233 on the 10. Are we talking sub 2 or not that good?
Well, I'm not going to make that call because that's 30 basis points, quite a big call.
Okay.
But it's a relative value play, for example, so where we think there's more potential for that compression of yields between the spread between European and US yields, for example.